Division 296 tax, the new 3 million and 10 million super tax, has now officially passed both houses of parliament. It becomes law and takes effect from 1st of July 2026. There has been a long saga of earlier versions, headlines, and confusion, but the dust has finally settled. In this video, I'm going to walk you through a simple, plain English breakdown of Division 296 tax, what it is, how it works, who it affects, and what you can actually do about it. First, let me give you a super brief history of Division 296 tax, just to put this final version in context and avoid some potential confusion. Division 296 was first floated back in February 2023. Early versions proposed taxing unrealized capital gains and applying a single extra 15% tax on super balances above $3 million with no indexation. After a lot of backlash and consultation, the government made some significant changes to that original design. So if you're reading an article or watching a video on that topic that is more than a couple months old, chances are it's already out of date. Now let's take a look at this final legislated version. Simply put, Division 296 is extra tax on the earnings from the part of your total super balance that sits above the $3 million and $10 million thresholds. Let's break this down. Picture your total super balance as one long bar, cut into 3 slices. The first slice in blue is the first $3 million of your super. That part doesn't attract any extra Division 296 tax. The middle slice in red is a portion between $3 million and $10 million. The earnings on that slice attract extra 15% Division 296 tax. The final slice in green is a part above $10 million. The earnings on that top slice cover an extra 25% Division 296 tax. Normal super earnings tax is 15%, so with Division 296 on top, it effectively reduces the tax effectiveness for very large super balances. Importantly, both the 3 million and 10 million thresholds will be indexed to the CPI in $150,000 and $500,000 increments respectively. Another really important point is that Division 296 will not tax unrealized gains. That idea was in an earlier proposal, it sparked huge backlash, and it's now been dropped. Instead, it's based on realized earnings only. That means things like interest, rent, dividends, including the attached franking credits, and net capital gains on assets that have actually been sold. And it does not include contributions. Your super fund will work out your realized earnings for the financial year. The ATO then calculates the tax and sends you a Division 296 assessment notice showing how much you owe. This will happen in the following financial year once the full year's information is available. So the first assessment will be issued in the 2027 and 28 financial year. Division 296 is a new tax on individuals, not on super fund itself, even though the calculation is based on your super. So when you get that assessment, you will usually have around 84 days to pay. You can either pay it personally or ask your super fund to release money using an ATO release authority. Even people who can't normally access their super yet because they're too young can elect to have this tax bill paid from their super. Next, I will run through a simple example so you can see how the calculation works. Before we dive in, if you're getting value from this video so far, please take a moment to like and subscribe. It really helps the channel grow more than you might think. I really appreciate the support. Thanks heaps. I've built a Division 296 tax calculator. Once you enter the total super balance and the realized earnings, it tells you exactly what you owe. But I still think it's worth understanding the math behind the result so you can see which levers you can pull to reduce this tax. Let's walk through the steps. Now, the first number going into the calculation is the relevant total super balance. Your total super balance is basically the total value of all your super across every fund you have, including any pensions. For the very first year of Division 296, which is FY27, you enter your total super balance at the end of the financial year, 30th of June 2027. For subsequent financial years, however, you compare your total super balance at the beginning and end of the year and use whichever is higher. I've added this note into the calculator as a quick reminder. The first year method is a one-off transitional rule, and the higher of the two balances rule in later years is basically an integrity measure to stop people doing big withdrawals just before 30th of June to avoid the tax. Let's say your relevant total super balance is $12 million and your realized earnings for the year are $600,000. Step 1 is slicing up your super balance and working out what share each slice is of the total. For example, in this case, $7 million sits between $3 million and $10 million. And on a total balance of $12 million, that slice makes up 58.33%. The same idea applies to the other two slices. Here's a visual that updates automatically based on the numbers you enter. Step 2 is allocating the realized earnings across those slices using those percentages. So for example, 16.67% of the $600,000 is $100,000, and it sits in the top slice above $10 million. Step 3 is applying the Division 296 tax rates to the earnings in each slice and adding them up to get the total tax payable. Again, this chart updates automatically as you change the numbers, giving you an intuitive feel for how the logic works. If you want to check out this calculator, check the link in the description box down below. It's a small paid download. Your support helps me keep creating free videos like this. Really appreciate it. Now let's talk about what you can actually do if you are caught by Division 296. Can you withdraw funds to avoid this extra tax? In the first financial year FY27, Division 296 is based on your total super balance on 30th of June 2027. So withdrawing before year end may reduce or eliminate your Division 296 tax bill for that initial assessment. From FY28 onwards, the higher of your opening and closing total super balance will be used to determine whether Division 296 applies. So if your 1st of July balance is already above the threshold, pulling money out later during the year to below the threshold won't stop Division 296 from applying. But managing your year-end balance so it sits closer to your opening balance rather than letting it grow much higher can still cut the amount of tax you pay. Of course, pulling money out of super is not for everyone. You first need to meet a condition of release. And it can also mean paying more capital gains tax inside super or paying higher personal income tax. So before taking any drastic actions, please get personalized advice. This is especially important if you have a self-managed super fund, a defined benefit interest, or other complex structures, because there are extra moving parts that I'm not fully unpacking in this video. Now, if your super balance is large enough for Division 296 to be an issue, chances are your income is also high enough to be hit by Division 293, an extra tax on concessional super contributions for high income earners. If that might be you, check out my separate video on Division 293 tax, where I break down how it works, when it kicks in, and simple strategies to manage it. Thanks for watching. I'll see you in another one.